What's going on, buddy? Jeff here. Welcome back to the channel. All right, guys, I got a good video for you today. We're going to talk about probably one of the biggest arguments on FinTwit right now. Has the market bottomed? Okay, or are we going to see lower? Now, I've shared my personal take on this. I don't think that we have seen the bottom just quite yet. But then again, I could be wrong. We are all wrong all the time, especially when it comes to the stock market. But I want to take a look at some of the facts. This is an article I'd actually come across weeks ago, and I'm kind of surprised I haven't made a video, and I apologize. But it was brought up again, especially because I read a tweet from, a good friend of mine, just, really sharing how toxic, social media is, has gotten ever since the volatility has just continued to increase for quite some period of time inside the market. So we're going to take a look. I'm going to break everything down for you to give you guys a clear picture. And this is 100% factual. Okay. So let's get right into it. First off, here we are. I was taking a look at my charts every single weekend. I really like to prepare for the week ahead. What are some key levels? What stocks were relatively strong? What stocks were relatively weak? Okay. And where, like I said, some of these key levels are approaching. If they do get there, how I'm going to react to it. Taking a look at SPY, really sitting in this, this big zone. Are we going to reject off that 418, 417, 418, kind of come back down? Are we going to continue to hold? All right, as you can see, volume is kind of slowed down just a little bit. But like I said, I was, I really just got into this and I saw that tweet and it brought me over to this article. I'm going to share it with you guys. This is all about the Fed pivot. Okay, now you have two people standing on opposing sides. You have some people saying, listen, market hasn't bottomed yet because after the Fed pivot, the market bottoms. All right. And then you have other people, saying, listen, the market is very forward thinking, which it is, it tends to look 6 to 9 months out. And therefore, because they know that the Fed is going to pivot eventually, they're getting to a point where they're going to stop raising interest rates. The market bottomed back in October. So I want to break down this article. It's a very, very good article. You can go and Google it. It's Advisorpedia, Fed pivots and equity market bottoms. But we're going to highlight some of the main key points in this. And then after this video, I hope it just gives you a little bit better understanding. And if you are kind of trying to get away from that day-to-day trading, because like I said, it's not for everybody. And we, some people have jobs and they aren't able to be able to sit at a computer, or there's many reasons out there. That's fine. I hope this gives you kind of just like a more comfortable feeling going forward, especially for the longer term. Okay, so like I said, a Fed pivot means the Federal Reserve switches from a period of holding or raising their Fed fund rates down to lowering or easing. Now, I've talked about the 3 phases of the Fed pivot. All right, the first one is going to be the slowdown, then it's going to be the pause, then it's going to actually be the decrease. And the market's going to respond differently to all 3, okay? Now, this goes back, all right, since 1954, the United States had 10 full economic cycles, okay? And out of these, 10 recessions, 8 of them had a corresponding bear market. So they took a look at how stocks reacted before and after the Fed pivot during the recessions and gives you an entire breakdown. This chart obviously is a very confusing chart, but every single color represents a different cycle, okay? What has happened and so forth. And you take a look at these blue arrows, and it'll probably be easier if you go look this up, on your own. But this is when the Federal Reserve had pivoted. So really quickly, you see this gray line. It shows a pivot right here. Obviously, stocks had rebounded. This one over here shows, kind of like a brownish maroon. It shows where they pivoted, came all the way down here. Obviously, that they had pivoted again at that point. We talk about the multiple phases here, right? And like I said, it just gets to be a little bit complex. So I'm going to dive in a little bit further for you, okay? Like I said, the blue vertical arrow represents market bottoms. Then we dive in just a little bit further, and it shows that, you have that, like I said, I just talked about this saying of the markets typically bottom 11 days before the Fed pivot or after the Fed pivot and so forth. And it goes to show that there's 2 things to this, okay? The first one is, okay, that if you buy during a Fed pivot at any one of those 3 phases during a Fed pivot, it usually yields a positive return 1, 2, and 3 years out. The only times this has not happened is during the tech bubble and the financial crisis. The financial crisis, obviously, because it was also a bit of a credit crisis, okay? They were not lending as much and economic growth really, really slowed down. The other time during the tech bubble, okay, which I was obviously too young to be able to trade in this, I was only 10, 11 years old, is that your PE ratios were sky high. You had companies that really were just, didn't even have much revenue. We're talking kind of like almost like a microvision back in or 2020, 2021. Okay, you had companies that were just, really, looking at the future that was kind of uncertain, all right? And I think autonomous driving is even more certain than, some of these other companies back during the tech bubble, because there was a time when they thought the internet was just a fad. Okay. But PE ratios were insanely high. That's why the tech bubble kind of falls into there. One can also say that the market bottoms after the Fed pivot in 4 of the past 5 times since 1980. Now, this chart shows the Fed pivot date, what was, the increase, before the decrease, how much it was moved, and what were the 1, 2, and 3 year returns. And obviously, as I just had said to you, it's generally positive 1, 2, and 3 years out, except for the 2 scenarios that I just situated. But this is very interesting to show 4 out of the past 5 times since 1980. Okay, it is bottomed after. Okay, so I want to give you, like I said, another just kind of clear picture when it comes to like before or after. And I think the biggest reason really isn't to trying to time exactly when this is going to occur, because I've always said I'd rather be a little bit early than a little bit late. Chances are I don't really know when I'm going to fall into it. My long, portfolio, obviously besides, a couple of those, tickers that I hold, one being, still AMC, is also the fact that I've liquidated a lot of that long portfolio. I haven't started adding back into it, but it comes down to the bull, the bear, where the market is going. Okay. If you are a long-term investor, you need to establish yourself as a long-term investor and be comfortable with the fact of, listen, like I might not be able to hit the bottom exactly. I might be a little bit early, I might be a little bit late, but at least this gives me a general idea of when to start dollar cost averaging it into some of those great tickers. Okay, especially if you're looking, into ETFs. Obviously, stocks are going to be affected differently. You look at Nvidia, who's ran well over 100%, since its bottom. Tesla is another 100%er, and you look at other ones that haven't really recovered that well, like such as Amazon. Okay, from when it's hit its most recent bottom, and to be able to kind of find out exactly where you want to be able to position it. But if you are like I have, turned into, which is pretty much, I've gotten away from the small caps because they don't really run that heavy. I've been, continuously focusing on options. Doesn't matter really where the market is going day in and day out, whether it's up or a down. And if you establish that, you can come into the market every single day with a clear mind. Okay. So like I said, I hope this video might have been a little bit too much, but like I said, I hope it gives you an idea. You can go out and check this article out. Fed pivots and equity market bottoms kind of just shows this a little bit of light. And obviously it explains it in much deeper facet than I had shared with you guys about the whole, all the markets already bottomed, or all the markets are going to bottom after the Fed pivot, or the Fed pivot is going to be good for the stocks, because it seems like every single time they talk about lowering rates, the market does pop a little bit. But like I said, that is very, very small time frame than a bigger one. But it also helps drown out the noise, because Twitter, while it can be very, very informative and there's a lot of information shared, I've met some amazing traders on that platform. It could also be very, very toxic, and people really get sucked into which way the market is going. And it's like, if you come into the market every day with a fresh mind, because that's what you've been doing, then that really shouldn't matter. Okay. So guys, that's it for this video. I'll see you in the next one.